What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to dig into the question that we received from one of our listeners. And that question is, can I 1031 exchange one of my short-term rental properties? The short answer to that is yes, it is possible. But as with everything, it comes with some strings attached, meaning you need to follow all the usual 1031 exchange rules, and in some cases, make sure your short-term rental qualifies. There's a safe harbor we'll talk about when it comes to that. So as a brief review, let's just refresh our memories. What is a 1031 exchange? A 1031 exchange under Internal Revenue Code Section 1031 lets you defer paying capital gains tax and depreciation recapture when you sell a piece of investment or business real estate. Now that's as long as you reinvest the proceeds into another like-kind property. So this means real estate for real estate. You can swap a single-family home for an office building, raw land for a duplex. It just needs to be real estate for real estate to be considered like-kind. Before the Tax Cuts and Jobs Act, there was all sorts of business property you could 1031 exchange, but once that passed in late 2017, it was restricted to real estate for real estate only. Now, in addition to that, the property being like kind, there's special rules you need to follow. So first, you have to use a qualified intermediary. So they're going to help facilitate the exchange. They'll receive the funds. You cannot receive any of the proceeds from the sale of your original property. That needs to go to the qualified intermediary, and then they will arrange for payment on the property that you close. So that having that qualified intermediary is key. You have 45 days to identify your replacement properties. Typically, it's going to be 3 properties. You have to close or complete the entire exchange within 180 days. Now, the 180-day clock runs concurrently with the 45-day clock. So they both start when you sell the property you're getting rid of, the relinquished property. And most importantly, as we already mentioned, the properties involved need to be like-kind and held for investment or personal use. So if you're using the property personally, likely not going to qualify. So where do short-term rentals come in? Short-term rentals, you think your Airbnb style setup, they have unique treatment under the tax code. And they offer the ability to use those short-term rental losses against your ordinary income. But there's 2 main requirements that you have to pass, or 2 main requirements before you can deduct those losses on your short-term rental. One is average rental period needs to be 7 days or less. So that's how you're going to qualify as a short-term rental. When the average guest stays 7 days or less, your property is not considered a rental activity under the passive activity loss rules. So this kicks you out of that default passive bucket, similar to qualifying as a real estate professional. But in this case, we're dealing with short-term rentals. So it's that average rental period of 7 days or less. Criteria number 2 is you must materially participate. Treat those losses as non-passive and deduct them against ordinary income. You must materially participate in a short-term rental, meaning you're actively involved in the operations of that rental property. Now, what counts as material participation? Well, generally, you're going to pass one of these 3 tests. There's 7 total tests, but these 3 are the most common that we see. So 1, you worked 500 or more hours on the short-term rental during the year. 2, you did all the work by yourself. Or 3, you spent 100 or more hours and more than any other individual working on that property during the year. Now be prepared to prove your hours and anyone else that worked on that property if you're going to use this as to prove your material participation. Now, if you meet any of these, the activities considered non-passive, your losses can offset other income like from your business or W-2 wages. This is a great strategy if you're involved in real estate but can't qualify as a real estate professional. For example, maybe you run your own business, you're a dentist, or you're a W-2 employee, so you're not going to qualify as a real estate professional. Short-term rental strategy can help you out. So you can use the short-term rental loophole have a cost seg study done to maximize your year one write-off, and later use a 1031 exchange to trade into a new property and avoid the capital gains and that depreciation recapture. So remember, in this case, you're exchanging real estate for real estate. I think what trips some people up is technically under Section 469, the passive activity loss rules, a short-term rental is not really considered a rental. So that only applies for the passive activity loss rules. More importantly, the short-term rental does meet the definition of property, real estate, being held for productive use in a trade or business or held for investment. So it does qualify as eligible property under a 1031 exchange. So to answer the question, a 1031 exchange can be used with your short-term rental, and it can be a really great strategy to save taxes. Now, one more thing before we go. So what if you own a vacation home that you sometimes use as a short-term rental, or a second home, you rent it out occasionally? Does that apply? Well, it can. According to IRS Revenue Procedure 2008-16, there's a safe harbor that applies to vacation homes or second homes when it comes to 1031 exchanges. You need to meet the following three criteria in order to qualify under the safe harbor. So first, you have to own the property for at least 24 months before exchanging. You have to rent it out at fair market value for at least 14 days per year in each of the prior 2 years. And you need to limit your personal use to 14 days or 10% of the fair rental days, whichever is greater, during those prior 2 years. So you're going to have very limited personal use. You have to have at least 14 days of rental days during the year at fair market value. So if you stick to those rules, good chance you'll qualify for a 1031 exchange on your vacation property or second home. So to recap, yes, you can 1031 exchange your short-term rental. You may even be able to do so if you only rent the property out for a few weeks a year for at least 2 years. So that about does it for today. I hope you found value in this episode. If you did, please hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.